OSI Systems, ticker OSIS, just dropped their Q4 2026 earnings and, well, they beat the consensus EPS estimate. They came in at $3.78 versus the expected $3.77. But they significantly missed on revenue, reporting $484.1 million against a $529.7 million consensus.
Yeah, and that weakness just bled right into their fiscal 2027 guidance. I mean, they're projecting revenue between $1.875 billion and $1.93 billion and EPS of 11.19 to 11.49. Both of those ranges are, well below Wall Street's expectations.
Right, and the market reaction was absolutely brutal. The stock plunged roughly 13.8% after hours to hit 52-week lows. So with an EPS beat, why did the stock get hammered so violently? We have to look at what dragged down the top line.
Well, the primary driver sits right in their security division, which is their largest segment. Revenues there actually dropped 7.4% year over year. Management cited geopolitical friction as the culprit.
Like the ongoing conflicts in the Middle East.
Exactly. Those conflicts are causing severe site access constraints.
Yeah.
That effectively delayed roughly $50 million in planned security deliveries right out of the fourth quarter.
But, I mean, this is where the market's reaction feels like an overreaction. This sounds like a delayed flight, not a canceled one. Management insists this revenue is deferred, not lost, backed by a record $1.9 billion backlog.
Yeah, that backlog is massive.
Right. So are retail investors just panicking over a temporary logistics hiccup here?
The backlog definitely proves the underlying demand is still there. But you have to remember that markets price in timing, not just eventualities. The orders haven't evaporated. They've just, shifted to the right on the calendar.
Because investors hate having to wait for the cash to hit the books.
Exactly. When investors can't pinpoint the exact quarter that $50 million will actually materialize, they discount the stock.
Okay, wait. If the top line took a $50 million hit, how did they still manage to beat EPS estimates?
It comes down to margin expansion. Their Q4 non-GAAP operating margins expanded 200 basis points, landing at 17.7%.
Oh, wow. 200 basis points is a lot.
It really is. The optoelectronics and healthcare divisions helped, growing 4.6% and 4.8% respectively. But the most critical management commentary highlighted a structural shift in the business model.
Right. They're moving away from purely hardware installations toward higher margin recurring services.
Exactly. Fiscal 2026 service revenues grew 13%, and that is huge, because once a massive security scanner is installed, the recurring software and maintenance fees cost the company almost nothing to provide.
But they bring in steady, predictable cash.
Yeah, and that recurring revenue effectively insulated the bottom line against those geopolitical hardware shipping delays. So a scanner might be stuck waiting for clearance, but the existing service contracts are still quietly generating high-margin cash.
And management isn't just talking about confidence in this shift. I mean, they are putting cash behind it. OSIS generated a record $276 million in operating cash flow for the year.
And they aggressively used it to buy the dip. They repurchased 564,000 shares for $123.6 million in Q4 alone. Plus, they authorized another 1 million shares for future buybacks.
So they see the cash engine running hot, which leaves you with a really provocative thought to mull over. If OSIS is successfully shifting to a high-margin recurring revenue model, is the market's obsession with short-term, delayed hardware shipments actually creating a rare value opportunity for long-term investors?
It's the classic tension between short-term logistical noise and long-term fundamentals.
Definitely something to keep an eye on. Make sure you follow the show for your daily earnings coverage, and we'll catch you next time.